In Chapter 8, we're now going to start looking at various other assets they could be service companies or merchandising companies. So we'll be looking at cash, fraud, and something called internal control. So from a conceptual level, we'll be defining what this thing internal control is and its purpose and principles. And we'll also be defining cash and cash equivalents and how we report them. You can look at the analytical calculation, which is a really great calculation for us to determine how well we collect our money on accounts receivable. It's called day sales. And we're not going to make you responsible for it in this semester. What we will be responsible for are the procedural ends. We're going to show you how to apply internal control to cash receipts and payments. We're going to explain and record what's called petty cash and show you how we make sure our cash account balances correctly. We're going to report it correctly. We're going to show you how to prepare a bank reconciliation. So if any of you out there balance your checkbooks now, it's kind of along the same lines. So let's go to our first objective, which is defining internal control and what its purpose and principles are. Internal control is a system within a company, and all companies have this. It could be written down or it could just be the way they operate. But large companies must have this written down and they must have an internal control system. So public corporations, it's required by Sarbanes-Oxley. And what they do, what this is, it's the policies and procedures of the company that are used to, and this is probably the most important thing in my mind as an accountant, protect the assets of the company. Nobody wants to steal a liability. And if they do, you can send them over to my house, okay? Because I'll put all my liabilities out front for them, right? Nobody wants to steal those. Assets are what people are most prone to steal. So we want to protect those as best we can. Ensure reliable accounting, something else that's very important. So this internal control system ensures that. It helps us to create reliable accounting. Uphold company policies. So a company may put rules, regulations, or general policies in place. But just because we write a whole bunch of stuff down and say this is the way the company should be doesn't mean it's actually happening. Internal controls actually forces it to happen. And it also promotes efficient operations. So the company is operating with the least amount of resources when we have a good internal control system. So it's going to protect the assets. It's going to make sure we're having reliable accounting. It's going to make sure people are upholding the policies of the company. And it's going to make sure we're working efficiently. That's what it accomplishes. As I said, Sarbanes-Oxley Act, which was became law, I believe, in 2001, 2002, written by two senators, Sarbanes and Oxley. We refer to it as SOX in the accounting world. It made a law that requires managers and auditors of public companies to document and certify the system of internal controls. So auditors have to audit this. Now, before Sarbanes-Oxley and even after with non-public companies, we always audited internal control. But this law requires it now. It was never required by law. We just did it because of our due diligence as accountants. That was part of the process. Section 404 of SOX requires that managers document and assess how well the internal control processes work and how they can impact financial accounting. So if you go to an annual report of a public company, you will see reports about the internal controls of the company. So I think it was right after SOX occurred. The Committee of Sponsoring Organizations was formed, and they're called COSO. And it doesn't matter who was on that committee or anything, but they were charged with finding what parts or what elements must be present in order for there to be good internal control. internal control, which would add to the quality of the accounting information. And I thought there might have been a slide for each one, but there isn't. So I want to talk a little bit about each one of these, and then we're going to dive into one, which is control activities or procedures. The first is control environment, okay? And that's really saying, what kind of environment does this company have? So we assess that as part of this internal control. And the rule is the tone starts at the top. So what kind of tone do the high levels of management provide throughout the whole organization? Do we have management in place that go, don't worry about those procedures. They're written down. We don't follow them, though. Or do we have managers that are like, no, this is the way we have to conduct business. These are our procedures and we're following them. Okay, or somewhere in between. So that has to be a very strong and positive environment in order for our internal controls to really add quality to accounting information. Risk assessment. As a company, we should assess risk that we have, maybe in our industry. Okay, I can tell you when I worked at WNEP, we did a huge risk assessment. Our huge risk was, what if we go off the air? What if our building burns down? Or, and this did happen to them, one of our towers falls over. What do we do? Well, you create a plan. So you assess the risk. What's the chances of that happening? If it happens, what the heck do we do? And you create a plan. And the more risk you assess and plan for, the better the quality of your business and your accounting information. Control activities, I'm going to kind of bypass because we're going to talk about them in a little bit more details. Information and communication must be very strong in your company. People who need the information to do their job and make the company stronger must have access to it. There must be good communication lines within the company in order to achieve good internal control. And just like anything else, you must monitor it. Now, what we have in large companies, public companies, are what's called internal auditors. And internal auditors are employees of the company who audit the company. And both large companies I worked at had internal auditors. US Foods, matter of fact, the guy in charge of internal audit was in the office next to me, and he was a spitfire. He demanded that our internal controls were being followed. And he would go, him and his team would audit each division of U.S. Food Service and look at every little thing to make sure everything we said would be happening in our procedures was occurring. And if it wasn't, somebody had to answer as to why. Same with WNEP. The New York Times, their internal auditors would come in and assess how well the company was following internal controls. And then we would have to answer to why things weren't being followed. Well, knock on wood, I never had an issue, but certain parts of the company did. So they're, in a large company especially, they are closely monitored. And they're also improved. Okay, so sometimes the internal auditors will be part of that process. The external auditors also monitor the internal controls. They're required by law, right? We just saw that with SOX for public companies, but even auditors who audit private companies still assess the internal control and let the company's owners, board of trustees, whatever it may be, know you have a good, strong internal control or you don't. And here's where you need to fix it. So we're always monitoring and improving. Now, some principles of internal control, and this comes into your control activities. Control activities are also known as control procedures, and that's really the core of internal control. So if you work in a company, say right now you're a cashier, okay, you were taught or trained on your job a certain way. So you just can't open up the register and start handing out money to people. Maybe you can only open your register if there's a sale. Okay, maybe at the end of the day, you count your drawer and then you stand with your manager and they count your drawer with you. These are all internal control procedures. So you're already part of it. Everybody in the company is part of this thing called internal control. And like I said, the core of it are the procedures that are in place. Here's some other principles that are common to all companies that are part of internal control. Everyone has responsibilities. Well, even before that, we're going to say this. Everybody is trained on their responsibilities, properly trained, and continually updated. We have responsibilities written down for each job. That keeps us efficient. We don't have Joe over there doing the same thing that Sue's doing over here. No, Joe has his tasks, part of his job. Sue has her tasks. We maintain proper records, and we're going to talk more about what a proper record is. We're going to make sure anybody who has access to large value assets, okay, is bonded, or the assets themselves are insured for risk of loss. Now, what we mean by bond is we get an insurance policy on the employee. So if the employee decides to commit fraud and steal something, the insurance policy will cover the value of that fraud. So we usually have these on people who handle cash. Now, a person has to be insurable. So, if you got caught stealing from somewhere else and they'll get a job and they try to bond you, that's not going to happen. Okay, so, there is procedures that an insurance company, it's part of their internal control, right? There's separate record keeping from custody of the assets, and that's one of the most important parts of internal control. We separate duties. We don't have one person in charge of all the responsibilities of an asset. And that's when you hear about the Boy Scout treasurer or the church treasurer or some volunteer organization's treasurer stole money. It's usually because they had too much control. They were given the checkbook and nobody watched them. Nobody looked at the checkbook. They kept all the responsibility on one person. Bad move. Bad move. You need to separate those duties so that somebody's always watching someone else, and that will help prevent fraud. You don't want somebody who is handling cash making journal entries related to cash. The cashier at the supermarket shouldn't be counting their own money and depositing it and making the journal entry for it. No, we separate those things. In large companies, this is done really well. In smaller companies, we do the best we can. We divide responsibility for related transactions. So we don't let somebody purchase inventory, receive the inventory, and make a journal entry that the inventory was received. We keep those duties separated. Think about it. You're the person at Best Buy who could buy large screen TVs. You buy the large screen TVs, they come in. You ordered 5. 5 came in, but you say only 3 came in when they shipped, right? And then you make a journal entry only recording 3 because you put the other 2 in your car. Keeping those duties separated will stop that from happening. We apply technological controls. So there's passwords, firewalls, encryption, and all the other crazy things that they're coming up with to protect our digital data. And we perform regular and independent reviews. Someone's always watching someone else. Sometimes we require mandatory vacation time. So and it's a whole week. So another employee could sit in that employee's chair and see what they're doing. Some people think, oh, look, they care about me. They want me to take a whole week off. No, they want to see what you're doing. Okay, so we need to establish responsibilities, as we said. So tasks should be clearly established for each person. Tasks should be assigned to one person. and because then you can determine who is at fault if there is an issue. We maintain adequate records. Maintaining adequate records protects assets. So you want to keep a list of all the equipment you own. You want to identify, you want to put identifications on those pieces of equipment. Okay, so there's all different kind of internal controls for each type of asset that we can do. This helps managers monitor the company activities, and it includes detailed records using our chart of accounts, using things like pre-printed forms. It's the scariest thing when you don't have pre-printed numbered forms, pre-numbered sales slips. Use point of sale systems, and that's what most computer cash registers are now. They only open at a sale, and as soon as the sale is complete, it's recorded right into the accounting system. So no, we don't generally sit around doing journal entries like we did in Chapter 5. Computers do them now automatically when the sale is made. Much more efficient. Insure assets and bond key employees, as we said. Employees handling a lot of cash and other assets should be bonded or insured. Bonded means the company has purchased an insurance policy against theft by that employee. So if the employee is able to steal, the insurance company, as we said, would reimburse the amount that they were insured for. And then the insurance company will go after the employee. Separate record keeping. Again, persons who control or has access to assets must not have access to that asset's accounting records. It reduces the risk of theft or waste of an asset. And employees would need to collude, agree in secret to commit fraud under this control. So internal controls does not prevent stealing 100%. So if you have 2 employees or 3 employees, one who orders the TVs, one who receives the TVs, and one who records the information about the TVs, and they all get together and say, ooh, I'll order 5, you say we only got 3, and you record only 3, we'll sell the other 2 and we'll split the difference. That's colluding. So you can't prevent it. But remember, you'll always get caught, and you'll usually get caught because someone ratted you out. So if you're going to commit a fraud, do it alone and make sure it's worth it. That's what I say. Divide responsibilities for related transactions. So responsibility for a transaction should be divided between 2 or more individuals. Ensures work of one person acts as a check on the other to prevent fraud or errors, and this is called separation of duties. So the person counting the cash, okay, usually 2 people count cash together to ensure accuracy, then the person in accounting would record it in the general ledger. Technological controls, as we said, cash registers make an electronic file record of each sale. Time clock records record exact time employee works. Personal scanners limit access to authorized individuals. And much more. We talked about firewalls, passwords, encryption. Regular and independent audits, we talked about that. Okay, so technology, fraud, and internal control. So when we have internal controls, separation of duties, okay, we have more extensive testing of records. That will lead to reduced processing errors, new evidence of processing, and increased e-commerce. And I'm trying to get all of these things together here. So internal controls, when we have good technological internal controls, that will lead to increased e-commerce, and there's a need for it because of that. We definitely need the separation of duties. If there could be extensive testing of records if they're available. Internal controls will reduce processing errors. And I'm not sure what they mean by new evidence of processing, but I'll take a look at that. If you guys have any questions, let me know. Limitations of internal control. Human error, carelessness or misjudgment, confusion. There's also human error that's intentionally defeating internal controls for personal gain, and that's called fraud. Human fraud is a triple threat. And I was just talking to somebody, excuse me, about this. I think I talk about it almost every day because I hear about some type of fraud. There'll be something on the news tonight. I've had friends commit fraud. I've had colleagues. I've had people in my church. And here's what happens. Opportunity, pressure, and rationalization. If you have those three elements, somebody's going to commit fraud. So it's called the fraud triangle. So if somebody has a financial pressure, they just want to look like they have money, they need to pay for bills, they want to go on vacation, whatever they perceive that pressure to be, that's a pressure on them. There's a rationalization. I deserve this money. They don't pay me enough to work here. I deserve this money. I volunteer and do this. Or I'm just going to borrow it and I'll pay it back. Those are some of the rationalizations. So to make it okay in someone's mind, that's how they rationalize it. And what we try to prevent is the opportunity. So if you don't have internal controls, separation of duties, keeping custody of the assets separate from the record keeping, you are giving a person opportunity to commit fraud. So internal controls tries to limit the opportunity. Without opportunity, you can't have fraud. That is why in those types of volunteer organizations, people usually commit fraud because they have these three things present. And if someone's volunteering to do something, nobody's going to say, are you stealing? Or, they're not going to question them. And a lot of people are afraid to question. They don't want the person to think that they're not trusted. Too bad, especially when you're dealing with a checking account. These things have to be dealt with. And basically, it could be one person is keeping track of the checkbook, writing checks and doing the deposits, and somebody else in the organization says, I'll reconcile the checkbook every month. It's just another set of eyes on that checking account. Just that alone could deter someone and not give them an opportunity. Okay, so that's why we see it so much. Now, when it comes to internal control, the costs of them to have all these separation of duties can exceed the actual benefit we're receiving. That's why in a large company, sure, we can hire these different people and give them that part of the duties and that part of the duty and that part of the duty over the asset. But in a small company, we generally don't have that ability. So we separate the duties as best we can and we monitor. Okay, so that's what internal controls are generally. Now, each asset has specific procedures that help ensure their protection, their accuracy, okay, and that policies are being followed. And my last one, I forget it off the top of my head, but the fourth one too. I'll think of it. So now we're going to define cash and cash equivalents and explain how to report them. Well, if you're sitting there going, well, I already know what cash is. Well, do you? An effective system of internal control that protects cash and cash equivalents should meet three basic guidelines. So this is key when it comes to cash. And cash is the asset that's most susceptible to fraud. So that's why we introduced this concept of internal controls in this chapter. Handling cash must be separate from record keeping for cash. So that cashier can't be sitting in the accounting department making journal entries. Cash receipts must be promptly deposited in a bank or in a safe that nobody knows the combination to. Okay? And cash disbursements must be made by check and they're authorized. We're going to talk more about this, but those are just three basic guidelines. So if you have been proceeding through this class thinking, are we putting this money in a checkbook? That's really the assumption. You are taking cash, bills and coins, and depositing them somewhere safe and only taking them out through proper venues. Okay, normally check. Now cash and similar assets are called liquid assets. Remember we talked about financial liquid assets because they can be readily used to pay current liabilities. So they could be used to be converted to cash and pay current liabilities. So cash, your currency, so your bills, your coins, and your deposits in your checkbook. Okay? Also includes items such as customer checks that are going into a deposit. Cashier's checks. So we don't wait till our bank says, hey, you know that customer that paid you the other day? Yeah, their deposit went through. No, as soon as we get the check, that's cash to us. We record, if a customer pays us with a check, we record that in our cash account today. Same with cashier checks or certified checks and money orders. They're all considered cash the day we receive them. Cash equivalents are very short term, highly liquid, so that means they're going to be maturing very, very quickly. Investments. They're usually from the date they start to the date they mature, 3 months. That's it. Anything more is not considered a cash equivalent. So they're readily convertible to a known cash amount, so you can go cash them in very quickly, and their maturity date is very soon, three months tops. So that's cash equivalents. So on a balance sheet, normally you'll see people write in their balance sheet cash and cash equivalents. Now, very important part of an activity of a business is the cash management. The goals of cash management are twofold. We must plan our cash receipts to meet cash payments when due. And we also must keep a minimum level of cash to operate. So what we have to do in the accounting department or in the finance area is try to predict when our cash is going to come in, and is that cash going to be able to pay our bills? That's part of our cash management. And then we need to keep a minimum amount of cash just to operate. What is that? So our cash management system looks at the following strategies. We try to collect our receivables as soon as possible. You saw that already. One incentive is offer a discount. Some companies actually sell their accounts receivables. Now, we're not going to talk about that in this semester, but that is something. So we try to get our money as quickly as possible. We try to pay our liabilities as late as possible. I'm not saying past the due date, okay? I'm saying we wait until the due date. That's just an element of business. Get your cash as quick as you can. Pay your bills as late as you can, because then you keep your cash, more cash on hand. Keep only necessary assets that you need. Plan your expenditures and invest your excess cash so that it's earning money. It's not sitting in a checking account with no interest. So these are some of the principles we follow as a cash manager. So what type of internal controls are on cash receipts and payments? Great graphic. This shows you how we create procedures for over-the-counter cash receipts. And this is in your book. And it illustrates that none of the people involved can make a mistake or divert cash without the difference being revealed. So a clerk rings up a cash sale on a register. The clerk prepares a cash count sheet at the end of their shift and keeps a copy and sends the other part to the company cashier along with the cash. Okay, so that's in the sales. So there's the cash sheet with the cash. The cashier's department, and this could be your manager, prepares a cash record, deposit slip, and a journal entry. So they're not the ones collecting the cash. They take the cash from the sales department and they create the information for the deposit. They then send a copy of the deposit slip and the cash sheet that was prepared by the sales department to the supervisor. I'm trying to read this. The supervisor then reads the register data, prepares the register sheet, and sends both to the company cashier. I'm sorry, they send both to the company cashier. They're reading the information. The deposit slip, and I'm going to take this one step further. The deposit slip with that cash sheet compared by another set of eyes in accounting, and then they make the journal entry after the deposit is made. So you can see there's people all involved in this process. The sales department, the supervisor, and the cashier, as well as the accounting. Sometimes when we're dealing with cash, like in a cashier situation, the cash register record may not come out, and the cash account may not agree with the record of the sales and the actual cash count. And we call that cash over and short. Maybe it's human error. You know, the cashier gave out too much change or not enough change. It happens. Sometimes error in making change are discovered from differences between the cash in the cash register and the record of the amounts of cash receipts from the sales receipts in the cash register. If a cash register's record shows 550 as the sales, but the cash in the cash register is 555, whoops, somebody didn't get $5 change. So the journal entry to record that sale would be debit cash $555, credit the sales for $550, and then we would credit an account called cash over and short. In this case, it would have a credit balance, so it would act as a revenue account, but sometimes it'll be short, so we would debit it. And then depending on where the balance is will depend if it is going to increase net income or decrease it. It will go on the income statement. So here's an illustration of where now the cash register's record shows $625 as the sales, but the amount in the cash register is only $621. So it looks like the human gave out $4 too much of change. Well, debit cash $621, credit sales for $625 or sales revenue. The difference you would debit to cash over and short. So that's how companies account for human error. What if our cash receipts come through the mail? And I've seen this in action. I used to audit years and years and years ago, back in the 1990s, the United Way of Wyoming Valley. And they have an awesome internal control system, or at least they did, when it came to cash receipts. They funnel millions of dollars through their system, and most come through as checks in the mail. So when they come through the mail like that, two people are usually assigned the task of opening the mail together, and they were. And what they would do is they would each make a list. I think they each made a list, I'm thinking, or you could just make one list, but both of them sat there and opened up the mail together. So there's no room for fraud. They'd write down who they got a check from and how much it was for. They would then take the checks with any kind of remittance to the cashier. The cashier then would make a deposit slip, take the checks to the bank, deposit them. Then the person that would make the journal entry takes the listing made from the clerks in the mailroom and the deposit slips. They got a copy of each one of those things, and they compare them and make sure they agree. So there's another set of eyes, and there's where we're going to find any errors or inconsistencies. Okay, and then they would make the journal entry to record the cash receipts. 4 people involved here. What about on the cash payment side? So we saw cash receipts, when money's coming in. What happens when there's cash going out? Well, the number one way of controlling that is authorizing payments and using checks. So control of cash payments is important, as most large thefts are from payment of fictitious invoices. And people think of the craziest things to do. So what they'll do is they'll make up a fake company. They'll give it like a P.O. box number, and they'll start sending invoices to the company if there's no controls with invoices, and have checks written to them, and it's really going to the employee. They're just fake invoices. So the keys to controlling cash payment is we require all payments to be made by check. And then we limit the access to checks, except for those who have authority to sign checks. So they're locked away in a safe or in a desk. And only the people who could sign it have access. If we keep a cash budget, that will identify if something weird is happening with our cash account. So if we're projecting cash receipts and cash disbursements, they should actually try to usually fall in line with what we're predicting. That'll help identify issues. What's important for companies, and large companies do this, they use what's called a voucher system of control. And it's really a process of verifying, approving, and recording liabilities for eventual cash payments, and then issuing checks for payments of only those items that are verified, approved, and recorded as liabilities. So you're not running into accounting with the utility bill going, I need you to pay this. It's a very organized system with procedures. So let's take a look at them. That is a voucher. Crazy, huh? So I'm going to walk you through. And not all transactions, all payments we make will allow us to have to, or even make us create this huge voucher file. But this is the typical way we pay for things such as inventory. Take a look. First of all, the very first thing that happens in a company is somebody needs something. We need more inventory. We need more supplies. We need something to work on in the manufacturing area, whatever it may be. So they create what's called a purchase requisition. And it's usually the manager of the department that ultimately does that. They send a copy of that. So the manager will keep a copy. They send a copy of that purchase requisition. You can see it going out to the right, to the purchasing department, which is a separate department, and the accounting department, which is in a separate department. Purchasing receives this purchase requisition, and they are very good at their job. Purchasing, all they do all day is purchase from vendors. They've already found the cheapest vendors with the best quality. They're usually friends with the people they talk to on the phone because they talk to them all the time. So they're going to be able to get us the purchase quickly and at the best price with the highest quality. Purchasing will create what's called a purchase order. And on it will be who we're ordering from, what we're ordering, and the price negotiated for that. They will send a copy of the purchase order to the supplier, the person requesting. I don't agree with receiving. They shouldn't get a copy of it. Not yet. And accounting. I don't agree with that. So they're going to send it to the supplier to let the supplier know, hey, we ordered something. Could you guys fulfill it? Now, in the meantime, the invoice may come, and if it does, it goes right to accounting. We're not going to pay it yet, though. Why? We don't know if we got anything yet. So what happens next is, in a separate area of the building, there's the receiving department. The receiving department, all they do all day is receive goods. They make a receiving report, and on it, it lists what they got and how much. They'll send a copy of that to accounting, the department requesting the item, and to purchasing. Okay. From there, accounting takes the invoice and matches it to the purchase requisition. First of all, did anybody ask for this and who was it? Okay. Purchase order. Oh, okay. So they asked for it and here was the purchase order that was created. Okay. So what's on this purchase order? How much we ordered, what we ordered, and the negotiated price. So we want to see on the invoice, is that the same price that was negotiated? And is that the same item? Then we're going to look at the receiving report to see how much we got. Compare that to the invoice amount. Oh, are they charging us for what we actually received? So all of these documents are very important in the process, and they're all being completed by separate people. At that point, we put that invoice package together and we have somebody approve it to pay. Not the cashier, but somebody else will approve that to be paid. and then it's entered into the system as a liability. From there, the cashier will write a check. Okay, so, and you could see there. So the requesting party sends it off to purchase and accounting. The purchasing department sends it off to the supplier, the requesting department. I don't agree with receiving and accounting. I don't want receiving to know how much I ordered. Okay, the supplier will send to accounting an invoice. The receiving department will create the receiving report, send a copy to accounting and the other two departments. Then accounting matches up the invoice with the purchase order, purchase requisition, and the receiving report, has it approved, and sends it off to the cashier. And then the cashier sends a check to the supplier. See all those different people involved? That's how you protect cash. So again, purchase requisition, purchase order, invoices received, and the receiving report. All of these items must match up and agree with one another. The accounting department will record purchase and approve payment after all documents are in order. Information across all documents are verified. Approval is created. There's an invoice approval, and a checklist of steps necessary for approving invoice and payment are present. These are all internal controls, guys. Look at how specific it is. Very important. We don't have one person doing everything. The voucher is complete after the invoice has been checked and approved. It's used to authorize the recording of the obligation as a liability until the check is cut. Certain information is required on the inside of a voucher. We're not too worried about that. And certain is required on the outside. Okay, we just want you to be aware of what this voucher system is. And it's actually like, you can think of it as a manila folder with all this information in it. Or it could just be all the paper stapled together, okay, with an authorization on it. Okay, so now we looked at the nitty-gritty of cash and those internal controls. How we protect cash if it's coming in, whether it be cash or checks. How we protect cash when it's going out. We try to only do checks. But what about little small disbursements? Well, sometimes it's inefficient to write a check for every single payment. So companies create what we call a petty cash fund, and that will handle very small cash transactions. So let's take a look at that. Small payments for items such as like shipping fees, little repairs, maybe low-cost supplies or fuel, or somebody went out to lunch with a client, reimbursing them, but it's not high dollar amount. And every company will decide what that small payment amount is. The day we decide to open up a petty cash fund, we establish it. So this company established a $75 petty cash fund. You debit the asset, petty cash, credit cash, because that's where the $75 came from. So generally what happens here is we pick a person to handle, one person to handle the petty cash fund. They'll write a check in their name and they'll take it to the bank, that's $75, and get the bills and coins. They'll bring them back to the office, and now they have a petty cash fund, which, by the way, it will have a lock on the box they use, and it'll be locked in their desk and locked in their office. Levels of security. They're responsible for it. Each time a person comes in to request a reimbursement from petty cash, they must have a valid receipt. So it must be a valid receipt and for a business reason. And what the petty cash clerk will do is they create what's called a petty cash ticket. And it's just like a little form that will have the date that they reimbursed the person, what it was for. Okay, so like here, miscellaneous expense. It was for tile cleaning. Okay, the dollar amount, $46.50, and then they'll both sign it, the clerk and the person receiving the cash. It just protects everybody. And then the clerk will staple the receipt to that little petty cash ticket. So every time he gives a reimbursement out, that's what he's going to do. So what you see in front of you here are various reimbursements that the petty cash clerk made during the month. So you could think of these as the petty cash tickets. Tile cleaning, $46.50. They paid for transportation of their merchandise coming into the company, $15.05. They paid to send a customer merchandise, $5. And then they have office supplies. They purchased some office supplies. So a total of $71.30. So the $75, $71.30 has been distributed for these various items. So now the petty cash clerk is going to say, I need to replenish or reimburse my petty cash fund. I need to get bills and coins back in there. So what they'll do is they'll take all of those separate receipts now and those little petty cash tickets, and they'll take them through that voucher process. They'll ask for them to be through the voucher process and approved, and a check be cut for the total of those items to the petty cash clerk so that they could go to the bank and put that cash back in their drawer. It's on the day the check is cut, the day the check is written to reimburse for those receipts, those petty cash tickets, that we debit each item separately. So on the day the reimbursement occurs, we're going to debit miscellaneous expenses, $46.50. We did not create a journal entry the day we actually gave the petty cash out. You just kept track of it on a little ticket and put it in your drawer. Merchandise inventory was debited for the transportation they had to pay for. Delivery expense is paid for the transportation to sell stuff to the customer. And then office supplies expense was debited for the office supplies. Then we credit cash. Notice we aren't doing anything to the petty cash account now. Why? Because we got the cash from the cash account to reimburse the petty cash. So at no time do we do anything to the petty cash fund for these transactions. The only time we will debit or credit the petty cash in the future is if we increase the amount of petty cash from 75, say, to 125, or we decrease it. That's it. And there we go. What if we decide to increase the petty cash fund up to $100? Well, now we'll increase petty cash 25 and credit the cash account because that's where we got the cash from to increase the petty cash fund. What if we say, gee, $75 is too much. Let's decrease the petty cash fund to $55. We're going to physically take $20 out of the petty cash drawer and put it back into our bank account. So we'll debit cash and credit petty cash. But that's it. Again, sometimes there's cash over and short, even in a petty cash drawer. I wouldn't let that happen, but it shows us here how to record the journal entry if that should. Okay, so believe it or not, we still have not gotten to the big, what I see to be the big part of the chapter. But one huge part was internal control. The other huge part is what we're about to get into. We're already 48 minutes in. Okay, so with regards to our checking account, we have all kind of internal controls already within it. Things like signature cards. Only people who have signed a signature card at the bank have the authority to sign checks or are authorized to sign checks or do activity within the checking account. Deposit tickets. They keep a running record of deposits made. Bank accounts themselves are just a protection of cash and internal control. Checks, we talked about that already. They're a written record. Signatures are required on them. Dollar amounts are written down. And electronic funds transfer. Then you don't even have a physical deposit or slip or a check that can be taken or modified or altered at all. You have money being transferred electronically between accounts, and then bank statements, which is a huge internal control, one we're going to be looking at. So here's our deposit ticket. So again, it's used to pay deposit money in the bank. We list cash and checks along with the amounts, and it serves as proof of deposits. And one thing I disagree with here, and I guess maybe it isn't there, the total deposit is the total deposit. Okay, you can't withdraw cash on a business checking account deposit. So like you can on a personal, see you later, like you can on a personal, you have to deposit all the money on the deposit slip. Here's a normal looking check for a company. Name of the company is there. That's the maker. The payee is the one the check is being paid to. The date is there. The dollar amount not only is written numerically, but in words, and the check is signed. A bank statement usually is sent to a company or a person who owns a checking account once a month. And the bank sends each depositor a bank statement showing all the activity in their checking account that the bank is aware of. So you can see here, this is going to Video Buster Company. It's their October 31st bank statement. And it says, you started with a balance of $1,610. During the month, I'm going to flip over to the other side here, you had deposits and credits. And to a bank, your checking account increasing is a credit. Okay? I'm sorry, I can't read that. 1,163 if I'm seeing that correctly. And then it says your total checks and debits are 723. So to a bank, your debits are decreases. That's why your debit card is decreasing cash. So at the end of the month, on October 31st, your balance is $2,050. And then below are the details of all those checks and debits and deposits. So the bank is keeping track of your checkbook. Well, of course, because they're the ones who have the money. But you also, or you should, but a company also keeps track of their checking account in their general ledger cash account. Now, here's the issue. If we're both keeping track of the same thing, when we get a bank statement, we should see the ending balance and go, okay, our ending balance is whatever, $1,200. If we grab our general ledger cash account for the same day, it should be $1,200 too. We're keeping track of the same things. Not necessarily. Because sometimes the bank knows about things that the company didn't know about. So the item will be on the bank statement, but not in the company's accounting of the checkbook. And vice versa. Sometimes the company has stuff in their checkbook. Maybe they wrote out checks or made a deposit, but the bank doesn't have them yet on their record because they just didn't know about them yet. So there could be missing items from each side. So a bank reconciliation is prepared to find these missing items, whether they're missing from the bank statement or they're missing from our checkbook, add and subtract those items as if they weren't missing, and see if we can get the balances to agree. So the common procedure we do and steps, normally, I don't know why, but all accounting books start with, let's see what the bank balance should have been. So what we're saying here is, here's our ending bank statement balance. Okay, it doesn't agree to our ending checkbook balance that we keep track of over at the company. Okay, why not? Some of the common items that are missing from the bank statement are listed there. The first is called deposits in transit. These are deposits that we have recorded in our checkbook. So according to the company, we got the money. We debited cash. But the bank hasn't processed that money as a deposit yet. It could be because we didn't take it into the bank till 5 o'clock at night. And if you look when you go to a bank, there's a little sign. It says, Transactions after 3 o'clock or 4 o'clock, depending on the bank, will not be processed until the next business day. So you could bring it in at 5 o'clock today, but you're not going to see it on your bank statement today. It's going to be on tomorrow's bank statement. So that could be an issue. Outstanding checks. These are checks the company wrote, have subtracted from their cash account, but whoever we wrote them to did not cash the check yet. So the bank has not subtracted that amount out of our bank account yet because they haven't been paid. And sometimes the bank just makes errors. So we have to correct those. So those are some of the common missing items or adjustments we have to make to find out what would have been the bank statement balance if they did know all this stuff and they didn't make this error. Then we grab our checkbook and we go through the same process and we look to see, is there anything the bank knew about that's on the bank statement that we don't have recorded yet? Some of the common items, if your checking account earns interest, okay, maybe the bank statement will show this interest on there. Now you could record it in your checkbook. Sometimes people will take money they owe you and take it right to the bank. They call it a bank collection. They take it right to the bank and they say, oh, you know that company? Put that in their checking account. I owe them that money. And maybe you weren't notified about it. Well, when you get your bank statement, you'll see that. So you want to add that to your accounting of the checkbook. Bank fees. You usually don't find out about those until you get your bank statement. So now you have to subtract them. NSF checks. And what an NSF check is a non-sufficient funds check. But it's not the company doesn't have enough funds. It's a customer. So somebody paid you by check company and their check wasn't honored. So the day, now I want you to follow me on this. I know you can't see it in front of you, but so if you want to write it down, you can. The day we get a check from a customer, we assume it's a good check. It's against the law to write checks that aren't going to be cashed into money. Okay, so the day we get the check, we debit cash for, say it was $1,000. Okay, and we take it to the bank and we deposit it. And the bank assumes it's a good deposit. So they will also increase our bank statement amount $1,000. But what happens here is at some point, as it's going through the banking system, the customer's bank said, no, either the customer didn't have enough money in their checking account, or maybe there's an incorrect signature or whatever. For whatever reason, the customer's bank said, we're not honoring that. So what happens? Well, the bank goes, oh, they're not honoring that. We better subtract $1,000 off that bank statement. That shouldn't have been there. And unless the company knows about it, they didn't subtract it out of their checkbook. So now they find out about it. And then, of course, we could make our own errors when we're doing our checkbook, put the wrong amount in. So we have to correct anything we may find during this process. So those are the common items that will change your checkbook balance. So there it is. We start with the cash balance per our bank statement, and it's always the ending cash balance per our bank statement. We search and see, are there any deposits that are in our checkbook? So we look in the checkbook and we compare it to the bank statement. The checkbook being our accounting of the checking account, the book accounting. The bank's accounting is the bank statement. So look to see, is there anything in our checkbook that's not on the bank statement as far as deposits go? If the answer is yes, that's a deposit in transit that should have been on the bank statement. How about our checks that we wrote out this month? Are all of those cashed? Are they on the bank statement? If there's checks that aren't on the bank statement, those are considered outstanding checks. Subtract them. They should have been cashed. That money isn't available. And then any bank errors will be corrected. And then we come to what's called the adjusted bank statement balance. What that's saying is, if the bank knew everything that we knew, that would have been the balance. We added and subtracted the stuff they don't have on their bank statement. We do the same thing with our checkbook, but now we're looking from the bank statement to our checkbook. is everything on the bank statement recorded in our checkbook. Things that may not be there, we talked about. Collecting money. The bank collected money, we didn't know about it. Well, now we have to add that to our checkbook. Same with interest. If the bank subtracted anything out of our checking account, it's on the bank statement. Those NSF checks and bank fees. Maybe we didn't know about them yet. If we didn't, subtract them. And then if we had any errors in our checkbook. And then we add and subtract those missing items and errors, and we get an adjusted checking account balance. The adjusted bank statement balance should equal the adjusted checking account balance at this point. We've accounted for all items in both places. They were either already there, so you didn't do anything with them, or they were missing. Once we find these errors and get those balances to agree, that's your correct cash balance, the adjusted cash balance. And you're not done. In our personal life, we're done. We're like, yay, my bank statement is, everything jives together. But in a company, our cash account balance has not changed. We just prove what it needs to be at. So we have to do one more thing. We have to make journal entries for any of the missing items on our checkbook side. Any items that were not in our checkbook. So here's an example, and this is from an item in your book on steps 1 through 4. So here we have the bank statement balance for Video Buster. The bank statement is $2,050. The book balance, their checkbook balance, the company's accounting of it is $1,405. Obviously, they don't agree. So the company goes and looks and says, oh, are there any deposits in our checkbook back at the company, but not on the bank statement? Oh, yes, there's one, $145, deposit in transit. So we add it to our bank statement balance. Are there any checks deducted out of our checkbook back at the company? Not on our bank statement, yes. Oh, yes, 2. Check number 124 and check number 126. Well, they need to be subtracted. They're outstanding checks. Once we do that, we've accounted for the items that are in our checkbook but not on the bank statement. And when we do that, if the bank did know everything we knew, they would have had an $1,845 balance. Now we do the same process, but we go from the bank statement to the checkbook. Our checkbook balance right now is at $1,405. And when I say checkbook, I mean the company's accounting of the checkbook. On the bank statement, it looks like the bank collected money for us on a note receivable, $485. So a customer walked in and said, we owe Video Buster $485. Throw that in their account. And also, it looks like we earned interest on our bank statement that we just found out about it. So we have to add that too. Then it looks like we have a check charge. We had some checks printed. On the bank statement, there was $23 subtracted. So we never subtracted that because we just didn't know about it. Now it's time to subtract it. And it looks like one of our customers' checks bounced, an NSF check of $30. So we'll subtract that now. So now we've accounted for the items that are on the bank statement but are missing from our company's accounting of the checkbook. And once we add and subtract those items, the balances agree. So the true balance of cash is $1,845. Okay, so there's all the steps. I think I went through more than 4 steps, right? Yeah, so there's the 8 steps in total. I know this is small, it should be in your book, but this is the journal entries. Remember, any item that is not in our checkbook must be added now. And we just can't go into our general ledger and start adding $485 and $8. No, we got to make a journal entry. So we're going to debit cash for $485, credit notes receivable, because that person paid us. For the interest earned, we're going to debit cash, credit interest revenue for $8. For the check printing, we could debit office expense or miscellaneous expense and credit cash. And then for the NSF check, we debit accounts receivable. That customer still owes us the money. We don't go, oh, their check didn't clear. That's okay. You don't owe us. No, put it back into accounts receivable. $30, debit it, credit cash. And then once we do that those journal entries, post those items, the cash account will then be at the proper balance of $1,845. Okay, so that is how we do a bank reconciliation. Now, as I said, I wasn't going to go into this. I think it's just the sheet. It goes to the end. There we go. So that's the end of Chapter 8. Again, the big chunk, internal control. What the heck is it? Why do we have it? How does it work? What are some specific internal controls over cash? We talked about petty cash and the journal entries related to that. We talked about bank reconciliations, what the heck they are, the steps involved, how we have to get those cash accountings to equal. They're two independent entities keeping track of the same thing. That's fabulous in accounting. Let's make sure we're both doing the accounting properly for them and find a true balance, and then create journal entries. So please post any questions you may have on the discussion board.